The next thing we're going to look at is the weighted average inventory costing method, and we're going to keep a running average cost for all of our units. And it's called a weighted average because you're going to look at your total dollar value and divide that by your number of units each time. So, January 1st, I have 8,000 units that cost me $40, and I'm going to multiply that out for 320,000, which is the cost of that inventory. If you have a room full of $40 items, then you already know that the average cost per item is $40. So then on the 19th, we sell 5,000 units, and here we're going to use for the cost of merchandise sold, we're going to use the average cost here. So 5,000 times an average cost of $40 each is 200,000. And then you have 3,000 left at an average cost of $40 each, which is 120,000. On the 30th of June, you purchased 12,000 units at $48 each for a cost of $576,000. Now we've got to recalculate the average cost per unit. So the first step you're going to do is you're going to add this 3,000 here with this 12,000 here to come up with your new total number of units. So 12,000 plus 3 is 15,000. The next step is you're going to total the total cost. So you're going to add 120,000 plus 576,000, which is going to give you 696,000. Now you need to come up with the average cost per unit. So you're going to divide the total cost divided by the quantity, which is 15,000, to come up with an average price of $46.40, 46.4. On the 2nd of September, you're going to sell 9,000 units, and you're going to put the average cost in there of $46.40 per unit. Multiply that out, you get 417,600, which is your total cost of goods sold. And then, if you had 15,000 units, you sold 9,000. That means that you have 6,000 units left at an average cost of $46.40. And when you multiply that out, it's 278,400. November 15th, you purchased 2,000 $50 units for a total cost of $100,000. And every time you make a purchase, you need to recalculate your average. So now you total up your number of units. At this point, you have 8,000 units in ending inventory, and your total cost is $278,400 plus $100,000. So it's 300. I'm going to have to skip a space here. 378,400. And if you divide 378,400 divided by 8,000, it's $47.30. So your ending inventory is valued at, I'm going to rewrite that amount down here. It's kind of hard to read. Running out of room on my notebook. 378,400. Cost of goods sold, well, you sold 14,000 items, same as above, but this time the cost was based on weighted average is 617,600. So there are the three charts for FIFO, LIFO, and this one at the bottom is the weighted average method. And 6A talks about lower of cost or market. There may be times when you have inventory that is not worth as much as you paid for that. And in that case, you have to choose what is lower the cost on your books or the cost in the market, the current price in the market. And so what we have here on problem exercise 7.6a is we have item B, which has a cost of $80 but a market cost of $78. So we're going to use that $78 to value that inventory. And item M has a cost of $60 and a market of $64. So what you see me doing here is I'm comparing the cost with the market value. So lower cost or market, first you choose the cost, which is lower, either the cost in your books or the market price, and then you're going to multiply that out. So 450 units times $78 is $35,100. $75 times $60, which is our lowest number on the second row, is $4,500. So we would actually value our inventory at $39,600. This is only acceptable when the price of your inventory or the value of your inventory is actually below what you paid for it. So it's only in special circumstances that you would use this. Practice exercise 7.7a talks about an ending inventory era and how that would affect the financial statements. Now, this part is not on the test. It's kind of a critical thinking exercise because it's going to take you through the balance sheet and the income statement. Okay? But you see that ending inventory was recorded for $113,900, but the correct amount it should have been recorded at was $118,350. That means that inventory was understated by $4,450. So we're going to think about the total effect on the balance sheet. So first of all, your inventory account, merchandise inventory, was understated by $4,450, which means that current assets would be understated by $4,450. And I believe in Cengage you might need to put a minus here because it is a negative number because it's understated. That also means that your total assets will be understated by $4,450, which also means that your owner's equity will be understated by $4,450. Now, on the income statement, you will also have an effect because cost of merchandise sold will be overstated by that same amount. That means that your gross profit will be understated by $4,450, and your net income will be understated by $4,450. So you see how one small mistake in counting that ending inventory can affect the balance sheet and the income statement.